before you learn what is Forex trading, you need to understand what is Forex first. So the term Forex basically stands for foreign exchange. The foreign exchange market is the global marketplace where the world's currencies exchange hands at a mutually agreed rate, which is what we call an exchange rate. These exchange rates change every single second, so the market is constantly fluctuating. So what we are essentially doing as Forex traders is that we are speculating on this exchange rate, on whether it will go up or go down. Now, the Forex market is actually the largest financial market in the world with a daily trading volume of $6.6 trillion. Not a million, not a billion, but trillion with a T. It is also 200 times bigger than the largest stock exchange called the New York Stock Exchange, right? So based on this graph, you can just see how huge the Forex market is. And it's basically the market where there's the most amount of trading volume and the most amount of people, exchanging currencies every single day, right? So large financial market, lots of liquidity and lots of volume. Now, the Forex market is open 24 hours a day and 5 days a week from Monday to Friday, and it is only closed on the weekends. Therefore, unlike the stock or the bond markets, the Forex market does not actually close at the end of each business day. Now, Forex trading is basically the conversion of one currency into another. Example, you are converting the Great Britain pound to the US dollar, right? So we all have probably seen this, right? At the airport or whatnot. It's basically like a currency exchange booth. So let's say today you go from UK, you go from London, and then you travel to the United States. Maybe you go to New York or something. And in that case, you cannot be using the currency that you use in UK, which is pounds, in US, right? You have to convert the pounds into US dollar. So you would usually go to this currency exchange booth and tell them, hey, I want to convert my pounds to US dollar. And then they will give you a certain exchange rate, and then that is when you are able to convert however much pounds that you have into US dollar. Now, when you do that, when you convert your pounds into US dollar, you are essentially participating in the Forex market, right? So, yeah, you probably have been trading Forex without even realizing it. As long as you have traveled to any other countries other than your own one, then you have participated in the Forex market. So, Forex markets are always quoted in currency pairs. The base currency is on the left of a currency pair, while the quote currency is on the right. The base currency is always equal to 1, and the quote currency is always equal to the current quote price of the pair. So this means that the price of the pair, in this case, EUR/USD, the price of the pair is this one right here. It's basically stands for how much of the quote currency it costs to buy 1 unit of the base currency. So when you trade Forex, you are essentially buying one currency while selling another. Let's look at this example that we have right here. For example, EUR/USD equal to 1.35361. So in this exact scenario, Euro is the base currency, right? Because it's on the left. USD is the quote currency because it's on the right. And what it means here is that it would take 1.35361 USD to purchase 1 euro. Okay. So once again, if you go Google and search, let's say you want to convert euro to USD. So you search euro to USD in Google, and it will probably come up with like a graph that looks something like this. And what we have over here, this is a graph that actually displays the fluctuations of the exchange rate. So you can see 13 May, on the 3rd May, it was probably only 1.08, and then right now it's like 1.09, right? So it actually increased over the past few days or so. So in this case, when you see this right here, this basically means what? The EUR/USD is equal to 1.09. So it takes 1.09 US dollars in order to purchase 1 euro. Now, when you buy EUR/USD, you expect the price of euro to rise. So you buy euro, which is the base currency, and you sell USD, which is the quote currency. Now, if the euro strengthens against the US dollar, which means the euro goes up, right? Guess what? You make money. Now, when you sell euro USD, that means you are expecting, or rather you're forecasting, that the price of euro is going to fall. So in that case, you will sell euro, which is the base currency, and you buy USD, which is the quote currency. So if the euro actually weakens against the euro USD, right, it actually goes down, then guess what? You make money. So this is essentially how Forex trading actually works. Now, for one currency to go up, there will be another weakening against it. The rule of thumb is that all currencies cannot go up at the same time. Just think about it. It's basically the economy of a country, right? The currency basically stands for the strength of the economy of a particular country. So it does not make sense for all currencies to go up at the same time. There is always going to be a winner and a loser. That is just trading in general. Trading is a zero-sum game. That means if one currency is going up, the other one, the quote currency, is most likely going to go down, right? So same thing in trading. If you win, that means someone out there is losing. If you lose money, that means you're essentially transferring your money to someone out there, the winner, right? So Forex traders actually weigh up whether a currency looks likely to strengthen or weaken against another. Then they trade that pair accordingly. Now let's talk about who actually trades Forex, right? There's a few groups of people. The first one is what we have, the big banks, the investment banks, basically the big financial banks. And we also have your large financial institutions, like your hedge funds, your JP Morgan, basically all the big banks out there, as well as, your hedge funds, like the Soros Fund, even Warren Buffett's Berkshire Hathaway. Basically, all of these large financial institutions and big banks, they trade Forex, right? They actually manage like pension funds or investment funds, and in that case, they're going to use Forex to kind of hedge it, right, and trade with it. And then we got central banks and government. These people are very important when it comes to Forex, because they are the ones that actually come up with the policies, right, to actually determine the supply and demand of a currency. And when they do that, that determines the price of where the market is going to go, or where the currency pair is going to go in the long term. And then we got large commercial companies, right? Just think about it. Large commercial companies, they might have employees overseas. In that case, when they pay their employees, they need to convert the salary to their employees' country's currency, right? So yeah, another example could be, when you purchase something from the large commercial company. So let's say right now, example, I'm in Singapore and I want to purchase something from Amazon in the US. In that case, I go to, I saw this book that says that it's $20, right? $20 book on Amazon, so I purchase it. When I do that, once again, Forex comes into play, because my currency is SGD, Singapore dollars. So I have to, in order to purchase that, the bank, or rather Amazon, will automatically convert the 20 USD into SGD, so that I can pay them with SGD, and then they will convert the SGD back to USD, right? In that case, guess what? I've just essentially participated in the Forex market as well, right? So large commercial companies, they participate and trade Forex as well. And then there's the small fishes in the ocean, which is us, which is retail traders, which makes up like the smallest trading volume among these other groups that we have right here. So based on this, big banks, large financial markets, these are what we call smart money, and they are the one that actually controls the market, and they are the ones that's actually able to manipulate the market, so to speak, right? So that is why, as retail traders, we understand that we have no buying or selling power that is big enough to actually move the markets. So what we can do as retail traders is that we can only try to trade with them rather than against them. That's the only way to actually make money in the markets. Now, how do you determine whether a currency pair is going up or down? How do you know when to buy or when to sell? How do you know that the market is going up or down? How do you predict where the market is going to go? The truth is, as retail traders, we can't predict where the market is going to go. And we don't have to do so in order to make money. Because trading is simply a probability game, which means that every trade outcome is random. No matter how confident you are on a trade, it's always a 50 chance that you're going to win the trade and a 50% chance you're going to lose the trade. However, what we can do is that we can increase the probability of us winning a trade by developing what I call an edge. An edge is what separates winning traders from losing traders. You see, the thing about beginner traders is that most beginner traders, they don't have an edge, and as a result, they are not able to make consistent profits. Yes, they might make some money here and there, but they will always find it incredibly difficult to profit consistently. But as they master the 3 M's, which I'm going to go through soon, and start to focus on the process rather than the outcome, that is when they will transcend from the randomness of the market and start to make consistent profits. So your edge is basically your trading strategy that helps you make more profits than losses. As simple as that. So in order to develop your edge, you need to master what I call is the 3 M's, right? So the first M is method. You need to have a profitable trading strategy that works in every market condition. The second M is money management, right? You need to know how to preserve your capital so that you can actually grow your trading account rather than blow it and lose your money. That means you need to learn how to take trades with high risk to reward ratio while keeping your risk consistent. And then lastly, you got your mindset, which is where you need to learn how to actually control or rather manage your emotions when you are trading your live account, right? Especially when you have your hard-earned money on the line. You know, all your emotions will start coming into play, your fear, your greed, your FOMO. All these emotions are going to cause you to take stupid trades and make stupid decisions. And as the saying goes, if you play stupid games, you win stupid prizes, right? So you need to learn how to execute trades based on mechanical rules rather than your emotions. When it comes to Forex trading, we are essentially trading currency pairs. So these are essentially like your best friend. Now let's talk about what are the different types of currency pairs and which one should you trade. Firstly, you must understand what are currency pairs. Currency pairs is basically a price code of the exchange rate for two different currencies traded in the Forex markets. All currencies are identified by their own ISO currency code. Here's what I mean. When you see currency pairs like GP, GBP, GB stands for the Great Britain and P stands for pound, which is the currency for the Great Britain. So you can see all these currency pairs, right? If you look at their name, their ISO currency code, it shows you the country and the currency. And once again, another example, JPY, the Japanese yen. And you can see the first two letters is the country, which is Japan. And then the third letter is currency, which is yen pair. And then lastly, once again, the standard best friend of every Forex trader, the US dollar. You can see US, United States, the first two letters, followed by the United States dollar, which is the currency. That is why it's called USD. So basically, all currency pairs are identified by this personal ISO currency code, so that every single trader, when they look at a currency pair, they know exactly what they are trading, what country is this currency pair from, and what is the currency that this guy is actually trading. Now let's talk about the different types of currency pairs. Firstly, you got the major currency pairs. Major currency pairs are basically pairs that include the US dollar. Things like your Euro USD, GP USD, NZD USD, USD JPY, USD CHF. Now, if you're not familiar with this, this is basically the Euro USD, Great Britain pound against the USD, New Zealand dollars against the USD, and then the US dollar against Japanese yen, and then US dollar over the Swiss franc. So these are basically the main currency pairs inside the Forex market. What this means is that these major currency pairs, they have the most amount of liquidity, right? That means most people are trading these major currency pairs. They are like the most commonly traded pairs. This means that the market tends to present us more trading opportunities when it comes to the major pairs. USD CAD, I almost forgot this, the USD against the Canadian dollar. Now let's talk about minor currency pairs. Minor currency pairs are basically pairs that include any two of the major currencies except the USD. So basically, minor currency pairs is basically any of the major currencies like your Euro, Great Britain pound, NZD, JPY, CHF, Canadian dollar. Any two of these major currencies, you combine them together, you get your minor currency pair. And every single minor currency pair, there is no USD inside. It excludes US dollar. So, example, Euro JPY. Euro, a main currency pair, JPY, and also a main currency, another major currency. And then you got Euro CHF, Euro Swiss franc. And then you got GBP AUD, the Great Britain pound against the Australian dollar. And then you got GBP JPY, Great Britain pound against the Japanese yen. And then you got Australian dollar against the Canada dollar. And then once again, AUD against the Swiss franc, the Australian dollar against the Swiss franc. Lastly, you got the exotic pairs. These are the pairs that is dangerous. This is the ones that we don't trade, alright? Because why? Nobody trades them. First of all, nobody trades them. And second of all, there's extremely low liquidity and low volatility since nobody is trading them, which means price tends to go crazy when like a news event come out or whatsoever. So these are basically the pairs that include one major currency pair and another currency from emerging markets like Africa, Thailand, what else? Mexico, yeah, basically from emerging markets. So it's example like USD SGD, the United States dollar against the Singapore dollar, or the United States dollar against the Thai bahts, and then Euro against the Hungarian dollar. I think that's the Hungarian currency. I don't know what's that. And then you got the Australian dollar against the Mexican peso, and then there's Canadian dollar against SGD. So all of these are examples of exotics. As much as possible, we try to stay away from exotics, because let's be honest, you're not going to make any money from trading exotics. And if you're not going to make any money from trading exotics, what's the point of actually going through them, right? This is just for you guys to understand that these things exist. These exotic currency pairs exist, right? But for you, just stick to what's worked, which is either the major currency pairs or the minor currency pairs, which will present you much more trading opportunities. Next, which currency pairs should you be trading? That's the million-dollar question. I will advise you, if you are a complete beginner, which I believe you are since you're watching this lesson, stick to the major currency pairs. Major currency pairs like what? Euro USD, GBP USD, NZD USD, USD JPY, USD Swiss franc, and USD Canadian dollar. The reason why I ask you guys to stick to these major currency pairs is because these currency pairs have a lot of daily trading volume, right? And they are the most commonly traded currency pairs in the world, which means that they're going to give you sufficient trading opportunities, right? Especially if you are a beginner, you will start to see a lot more trading opportunities as you begin to level up in trading, right? And these are the major currency pairs they can go to. Now, the good rule of thumb that I always tell my students, and what I do myself, is that I will always stick to 1 to 4 currency pairs. Right here you can see this is my watch list right now, and this is what you should not do at the start of your trading journey, right? At the start of trading journey, I will absolutely just ask you to focus on mastering 1 to 4 currency pairs max, right? 4 is like the maximum number. That's like, you should not go more than 4 if you are a beginner, right? And it's always going to be better if you become a master of one rather than a jack of all trades and master of none. Right, so I'll advise you, if possible, focus on mastering 1 currency pair. And maybe the reason why I want you guys to have at least like 3 currency pair inside your watch list is because if that 1 currency pair does not provide you with trading opportunity on that day, you can look at trading opportunity from the other 2 currency pairs, right? So yeah, stick to 1 to 4 currency pairs. And the reason why I have like 7 currency pairs right now on my watch list is because I'm an advanced trader, right? I've been trading for 4 years now. I know exactly what I'm doing, and it's much more easier for me to analyze the charts and actually come up with my bias and stuff. And right now, the thing is, I don't even like really trade all of them. You see, what I do is that I put like a red flag beside the currency that I believe that there's going to be an upcoming trading opportunity, and that's the one that I'm concentrating on. So if you look at this, I'm only concentrating on like 2 currency pairs, which is GBP AUD and NZD USD currently, because I believe that there's going to be an upcoming trading opportunity. So like I said, focus on maximum 4 currency pairs and you'll be good to go. Now, in order to become a Forex trader, you have to understand the way we speak. You have to understand the terms inside Forex trading. And that is when I want to teach you guys the Forex language and lingo. This is like somewhat like a dictionary for you guys to understand the terms that is commonly used inside Forex trading, or rather used by Forex traders. Firstly, what we have is pips. Pips is basically what I call or rather no, not what I caught, but what is called percentage in point. It basically stands for the amount of change in the exchange rate of a currency pair. A pip is the fourth number after the decimal point. So 1 pip is equal to 0.0001. So if you look at this currency right here, Euro USD, right now its quote price is 1.0926. In this case, the pip will be the fourth number after the decimal point. So this is the decimal point, 1, 2, 3, 4. There we have, that is your pip, right? So over here, right now, this is the pip. So it's basically the fourth number after the decimal point. So if this goes from 1.0926 to 1.0927, that means it increased by 1 pip. On the other hand, if this goes from 1.0926 to 1.025, that means it decreased by 1 pip. Now, let's go through a few examples. So, in this example right here, price went from 1.2468 for Euro USD to 1.2470. In that case, you can see, price just increased by 2 pips. Okay? And then another example right here, price went from 1.2576 to 1.2566. Price just went down and fell by 10 pips. Remember, how you get these 10 pips is you take this 76 minus 66. You get 10 pips. Over here, 68, 70, 70 minus 68, you got your plus 2 pips. And then last example right here, 1.2176, and it increased to 1.2276. In that case, you can see this right here went from 176 to 276, so it's basically plus 100 pips. Right, so as time passes, you will start to familiarize yourself with this concept of pips. Right, this is essentially like how we used to measure the change in the exchange rate of a currency pair, and it also allows us to measure our profits or loss. Now, for Japanese yen pairs, it's a little bit different because Japanese yen pairs only go up to 2 decimal places. Right, so Euro USD, all the major currency pairs, all the minor currency pairs, they have like a string of numbers like this. Right, but Japanese yen currency pairs, they only go up to 2 decimal places. So you look something like this, 170.67. In that case, 1 pip is the second decimal place, the number in the after the, yeah, how do I say this? The second number after the decimal point. So in this case, the second number after the decimal point is this one right here. So this one right here is your pip for Japanese yen pairs. So if price of Euro JPY go from 170.67 and it increased to 170.68, then guess what? Price just increased by 1 pip. If price goes from 170.67 to 170.65, price just decreased by 2 pips. Now, there's also this thing called your pipettes. Pipette is basically micro pips. It's 1/10 of a pip. So a pip is like the fourth number after the decimal point. A pipette is basically the fifth number, right? So in this case, usually if you go to TradingView or your broker, you will see that the currency quote price looks something like this, right? The string of number that we have right here, and then there's like this small little number right here on top of like basically the pip. Yeah, on top of the pip count, there's this small little number. In that case, that is the pipette. So right here, this is the pipette, and if price goes from 1.09263 to 1.09265, you can see the pipette change, right? So 3 to 5, this means it just increased by 0.2 pips, right? So 1 pip is basically 10 pipettes. So it's like 0.1 pip is this number right here, right? So if price goes from 1.09263 to 1.09265, that is plus 0.2 pips. Now, lot size. Lot size is basically the size of your position, or rather how many units are you buying or selling of a particular currency pair, because Forex is traded based on lots. Now, there's 3 types of lot size. First one is the standard lot, the biggest one, and that is when it's what is called one lot, right? It's like a volume, 1 lot. In that case, that means you are either buying or selling 100,000 units of that currency pair. So if you are buying 1 lot of Euro USD, that means you are buying 100,000 units of Euro USD. And that means every time price increase by 1 pip, you are making or losing $10. And every time price move by 1 pip, that is $10. Okay, then next, there's the mini lot, which is your 0.1 lots. In this case, you are buying or selling either 10,000 units of EURUSD or GBPUSD, right? In that case, every time price move by 1 pip, it's only a $1 increase or decrease. And then lastly, you got your micro lots. That is your 0.01 lot. That is the smallest lot size that your broker will allow you to trade with. In this case, you are buying or selling 1,000 units of EURUSD or whatever currency pair that you're trading once again. And this time round, whenever price move by 1 pip, it's only moving 10 cents, which is $0.1. Right, so that is your lot size. Now, I want you to make sure that you really familiarize yourself with these terms. Firstly, bullish. Bullish means that you are expecting price to increase. Bearish means that you are expecting price to fall. So if I say that I'm bullish on EURUSD, that means I'm expecting Euro to go up in price. If I'm saying that I'm bearish on Bitcoin, that means I'm expecting Bitcoin to go down in the near future. Long means buy, short means sell, right? As simple as that. So if I say that I'm longing EURUSD, that means I'm buying EURUSD. If I say that I'm shorting Tesla stock, that means I'm selling Tesla stock. And then stop loss. Stop loss is basically a preset price where your broker will automatically close your open trade, your open position, if the trade does not go as planned, right? So when this happens, it protects your capital and it prevents you from losing more money than you want to lose. And then your take profit is the profit goal that closes the trade if the trade do go as planned, right? So if you manage to win the trade, that means that price has most likely hit your take profit, right? Price most likely hit your take profit and you got out at the goal that you set out for yourself for this trade to play out. In that case, the trade went as planned, it hit your take profit, you make a profit, right? Then stop loss is basically the opposite. So if the trade does not go as planned, the broker will automatically close the trade at a preset price and prevents further losses.